Hello and welcome to Portfolio Watch. I'm Gugulethu Mfuphi, and in today's episode we take a look by reflecting on what has been a very difficult month for the year of 2018 when it comes to investing. That's the month of October. So we'll reflect on some of the investors' concerns, especially given the ongoing dynamics of changing macroeconomic dynamics in both developed and emerging economies. In studio today, I'm joined by my guest, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Henry Biddlecombe, Equities Analyst at Anchor Capital. Gentlemen, good to have you both with us. I actually think that we should be celebrating the fact that we managed to survive September and October, both being very difficult months on the investment front. So, and I can imagine managing your clients' expectations has been super difficult too. But Andrew, let's start with you by really getting context into what has taken place globally, which actually has seen a resurgence of investors' concerns when it comes to the macroeconomic dynamics.
Yeah, so I think, we talk about sell in May and go away, but for some reason, October, if you look back over the years, October always seems to be the month of the year, or the month that stands out during the year that performs the worst from an equity point of view. And it doesn't matter where you look, locally or globally, the US, Europe, etc. There's obviously a number of investor concerns, I think, around economic growth, how long the US can continue to grow. We've spoken about this before. They're reaching, record number of years of an economic recovery. I think it will be 10 years next year, following the global financial crisis. Funnily enough, this month I think was the bottom of the market 10 years ago in the global financial crisis.
Sheesh.
And obviously then there was a lot of concern. No one wanted to be invested when it turned out to be the perfect time to be invested. Now we've gone through this 10 years of economic recovery, this bull market in the US that's done very, very well. Fed, starting to talk about hiking rates maybe quicker than anticipated next year. So this now starts to, unwind in the equity market, and we saw the concerns in October, but then end of October comes, and now we're almost, a third of the way through November, and the markets are sitting back up. Yeah. Even locally, we've seen the market recover, quite a bit. It's been up and down over the last few days, but where it was in the middle of October, it's recovered. People seem to have forgotten about October, and now we're looking towards the end of the year again.
Yeah.
Where it ends is anyone's guess. But I think, investors are nervous, and any sign of weakness coming out of China, US, wherever it might be, or talk of Fed rates hiking quicker than expected, we will see markets come under pressure.
Henry, let's bring you in here to build up on the themes that we see coming through from the US. We just had the midterm elections, the significant bull market performance over the last 10 years, despite the short-term sell-off. But again, this ongoing dynamic regarding stronger economic growth, Fed dynamics, and Trump still at the helm, it does raise a lot of questions and concerns as to what the direction of US equity stocks will be in future. How are you distilling a lot of this information?
So I think Andrew's on the money. The October effect is a real thing, and this year's October has certainly been no exception. And I do think that the market's been looking for a reason to sell off. Valuations in the US were looking a little bit extended, and the market's obviously had an incredible run. So it makes sense that October was the time for it to sell off. But I'm still, at the margin, quite bullish on US equities. I think that the American economy is in rude health. At the last print, their GDP was growing at 3.5%. We 90% of our way through the third quarter earnings season. So 450 of the S&P 500 companies have reported. And they've, on average, beaten earnings expectations by 7%. So they've grown earnings by an average of 27%, which I think is a stellar performance. And that's also been driven by 10% growth in revenue. So it's not all just share buybacks and tax cuts. There's genuine organic growth in that economy as well.
Mm-hmm. If we also take a look at Trump, you look at the US economy, trade wars, that conversation is also something that hangs heavy on the minds of investors, especially in the technology space. Is this an element that you have had to consider quite deeply?
So I think that issue is probably the most pressing at the moment, and it's certainly front of mind for me, and I'm sure for the rest of the market. The trade spat between the USA and China, let's be frank, is a very real problem.
Sure.
So they've levied tariffs on around half the trade with China, so on around $250 billion of trade. And they're threatening to levy tariffs on the other $250 billion. And certainly in the short and even medium term, that's growth negative. But I do think that this is probably an aggressive negotiating tactic. And my base case is that the US do reach some sort of trade deal with China over the next 12 to 18 months. But again, it's something that's very difficult to predict.
Andrew, that's very much the US focus and their relationship with the East. But what about Europe as well? This rising notion of nationalism also coming through and adding some pressure to the ECB there too.
Yeah, absolutely. And if you look at European company results that have also been coming out, not as strong as the US. So the European economy is definitely under more pressure than what the US is. So Henry touches on the US corporate earnings. They grew earnings 27-28%. That's an 8-year high. And you go across to Europe, and they're only growing their earnings at about 8% When you look at the companies that beat expectations from a revenue and earnings point of view, it's far less. I think it's less than 50%, whereas the US I think was around 80%. So the companies, this uneasiness that we're getting, this populism, I suppose, that we're feeling in Europe, in the US, etc., is being felt on the ground. People are unhappy with what's happening, whether it's politically, in Italy in particular is another area of concern. So yeah, Europe is definitely not in the same sort of space that the US is when it comes to an economic point of view. And as we know, economics drive corporate earnings, which drive investment returns. So it's unsurprising to see European companies under more pressure than US companies. But having said that, maybe that's a good opportunity, because valuations, those companies or those markets aren't pricing in the sort of growth that you're getting out of the US. So it could be an opportunity from an investment point of view.
Just very briefly though, so often on the show we've taken a look at very specific themes when it comes to the equities environment, whether it be technology or healthcare. Now that we've had October come and go, are we looking at a buying opportunity in some of the stocks that we'll touch on in a moment?
Yes, I think specifically locally, I know we've spoken about the US and Europe, but if you look locally, I think there were a number of opportunities, and there still are, particularly after the October that we had. And when you look at the SA Inc. Facing companies, which we've also spoken about before, I think there's some fantastic opportunities, to buy into companies that are highly geared to the local economy that will do well when the economy lifts up. Everyone's feeling very depressed at the moment because of what's happening. We got the technical recession that was announced, which I don't think is that technical. But when this recovery comes, which it will, it's just a question of when and how quickly, those sorts of companies will pick up. And here we're thinking of like the banks, insurers, your logistics, industrial companies, construction companies, and the like that are highly geared to recovery in the SA economy.
Sure. Well, let's take a look at some of those stocks now, ones that we should consider, especially as South African investors looking for opportunities locally and, of course, in the offshore equities environment. Let's take a look at some of those stocks. Andrew, let's touch on one of the local industrial stocks that many of us are quite familiar with, even though they've had interesting figures being published of late. Richemont, a well-known favorite, seen a slight revaluation in its numbers, but what's your take on this particular stock?
Yeah, so we like Richemont. They released their results, I think it was late last week, the interim numbers, and they were a bit of a mixed bag, but there were a couple of once-offs, and they bought that online business, Yoox Net-a-Porter, and I think that impacted the results a bit. So they came in below expectations, but the strong, or I suppose the story here relies heavily around China, and much less so, but I think a very an area that's holds huge potential for Richemont is India, where they're not really in at the moment. So when you think of the population there, in China you've got about 1.3, 1.4 billion, likewise in India. By 2025, which is only 6 years away, luxury spending, 50% is going to come from China, or is expected to come from China. And we know what's happening to online. When you think about Singles Day, Black Friday, what's happening in China last year, just the online spending in a single day on Alibaba was $25 billion. That's 3 years of ShopRite's total revenue.
Sure.
So it's huge. And they've partnered with Alibaba, and they're developing apps, so that Yoox Net-a-Porter, Mr. Porter can go onto Chinese mobile phones, because that's how they do their purchasing now. And I think that also holds a lot of potential for Richemont going forward. When you look from a valuation point of view, Richemont's fallen off a cliff over the last couple of months. From 130 Rand a share, I think at the end of August, beginning of September, now it's below 100 Rand. So it's 30% off its highs. And when you look from a valuation point of view, this looks very similar to what it was 10 years ago. It's the top of the global financial crisis, or at the bottom of the market, whichever way you look at it. So I think it's from a valuation point of view, it looks really attractive now as well. Great growth prospects. So yeah, we continue to like it despite the mixed bag of results that they released last week.
So Richmond, clearly still a firm favorite. I want us to look at a global company now that many of us are familiar with, Facebook, and perhaps juxtapose that with Amazon, which is also another key player featured on the show today. But let's begin with Facebook. As we know, stern favorite here on the show, leader in the technology space, and of course quite acquisitive with some of the operations that it's trying to expand on to drive that advertising revenue.
Yeah, so the data privacy issue has been a big thing in Facebook's life over this year, and we've seen their revenue coming under pressure. So I think their revenue grew. They released results also last week. I think their revenue was up 33%. But what's been very important in this earnings season is the outlook from the companies, getting guidance from companies what they expect going forward, because that's going to give you insight into what's happening on the ground, the economy, etc. Now, most companies are fairly comfortable. Facebook was the one that said their growth in revenue is going to decelerate, I think, by mid to high single digits, which is obviously not a good thing for Facebook. And there's a couple of factors playing into here. The data privacy issue, particularly in Europe, is one of those. Facebook, they obviously own a number of leading social media apps. They've got Facebook, they've got Instagram, WhatsApp, and then they've got their Facebook Messenger. I think that's pretty much the four. And they've got 2.6 billion users, or monthly active users. You've got to ask yourself now, where do new users come from? And I think this is probably one of the headwinds that they start facing now. Can they grow their user base? And the answer is definitely not as quickly as they have done. And if so, where are these people going to come from? Because 2.6 billion people, when you think about the number of people that have access to the internet, you're pretty much there or thereabouts. So where do their users or new users come from? But then on the flip side of that, where do they make the money? Through advertising. And companies are shifting from traditional advertising to online, and particularly mobile advertising. And that's where Facebook is making their money. There's a secular trend that's in place towards a shift away from traditional to online. So Facebook's obviously very much in line to benefit from that over the long term. They've just got to stay relevant, because Facebook is very often thought of as an older social media. My mom might have Facebook. My kids will probably never use Facebook.
Sure.
But Instagram is the newer one. And they don't actually divulge the numbers between how many users on Facebook, on Instagram, WhatsApp. They haven't monetized WhatsApp yet. So there is that potential there as well.
Exactly.
So there's a number of questions, I suppose, around Facebook, but a company we still like.
Company that you still like, and of course many other investors still potentially keen on. We will come back very briefly after the break to juxtapose that with Amazon, which I know is a firm favorite on your end, Henry. But do stay with us as we continue to evaluate many of these stocks to consider in your portfolio. Great buying opportunities, especially the dips that we've seen in the market activity in the month of October. Keep your questions coming by emailing portfoliowatch@abn360.com or tweeting at CNBC Africa, #PortfolioWatch. We'll be back with more after this. Welcome back. You're still watching Portfolio Watch, where we discuss investors' concerns, especially in reflecting on what proved to be a very difficult month for many investor returns during the month of October. In studio, I'm still joined by my guests, Andrew Dittberner, Chief Investment Officer at Private Client Securities for Old Mutual Wealth, and Henry Biddlecombe, Equities Analyst at Anchor Capital. Now, just before the ad break, we actually understood the macroeconomic themes. We also delved into just a few companies that proved to be providing some value in the market at the moment, and I want to tie that into what we have dubbed, or internationally has been dubbed, the FANG stocks. We touched on Facebook. Amazon is one of those that's listed there, Netflix and Google. And Amazon is one that you're very bullish on and keen on, Henry. Enlighten us here, especially given the opportunities that still persist when it comes to e-commerce and the investments that they're making in this particular space.
Yeah, it's an interesting one to pick, isn't it? Because the shares obviously run many thousands of % over the last couple of years, and investors have done very well out of it. But I think you're seeing an interesting shift changing in the market's treatment of the share right now. This is a business that traditionally has demonstrated tremendous revenue growth, and the market's given them the benefit of the doubt when it comes to profits. So they've almost applied a notional profit margin to revenues to value the stock. But I think that story is starting to change. The question is, why is it changing now? Well, for the third quarter, they guided to 15% revenue growth for the critical fourth quarter over the holiday season. And I think that was a lot lower than investors were expecting. And I think that's why you saw the share come under some pressure. But to counter that, you're starting to see the business become very profitable. So they reported around $5.70 in earnings relative to consensus expectations of just $3.80. So that's an incredible beat. I mean, that's a beat of 85% relative to expectations. So I think that the story is shifting from a revenue growth story to a profit growth story. But I don't think that that's a bad thing. The company is now growing up and it needs to start making money. And interestingly, it's now the cheapest it's ever been relative to profits. It's trading on a forward earnings multiple of around 49 times. And I actually think this isn't a bad time to start accumulating a share that I think is an incredible sort of secular growth story over the next 10 years.
Significant growth that's expected to come through from Amazon. And if you look at another company that also works within that particular space, more in the background though, facilitating payments, is PayPal.
Yeah, another great one.
Exactly. Tell us why you're bullish about this one.
Well, similar story on the share price, so investors have done incredibly well. It was in fact spun out of eBay in 2015. It was the payments division of eBay, and I think that's how most viewers would know the company. But it's actually developed into a global payments platform. It's almost platform agnostic, so you can use it to pay with any method, whether it's your bank account or your credit card or loyalty points even. And it's accepted by over 20 million merchants globally, and over 200 million users use it on a monthly basis. So it's a company that's starting to benefit from networking effects. It processes around $570 billion in transactions annually at the current rate. And that's resulting in meaningful positive operating leverage flowing through the income statement. And that's driving earnings growth of around 20 to 25% per annum.
Sure.
So even on a forward 30 earnings multiple at this stage, I think that if you buy the share now and you hold it for the next 10 years, you're going to do very well out of it.
So strong growth prospects, despite the numbers looking a bit steep for the retail investor. But of course, that's why we have individuals like yourself to guide us along these themes. Now, Starbucks is also one of those that has featured on the show before, and of course has seen a significant amount of growth in some of the new markets that they've tried to penetrate. Recently opened here in South Africa as well, and I think if we recall the queues, many South Africans can attest to how excited they were regarding the opening. But does the coffee beans translate into positivity and dividend growth for South African investors?
Chatting before, I think Henry's doing his utmost to push the Starbucks. I don't think South Africa moves the needle on the Starbucks story really, but what does move the needle is obviously the China story, and we've seen the growth that's coming through there. So Starbucks has been under pressure. They released their results last week. They've been under pressure, over the last year, and we've seen their share price come off quite a bit, and that's on the back of concerns around the growth story in China as well as US, what's happening in the US from a coffee point of view. When you think about when you drink coffee, it's in the mornings. Typically in the afternoons, those Starbucks shops are very empty because people aren't really drinking coffee in the afternoons, and product issues in that. So they've been innovative. They're new products, new store formats coming out. Their reserve bar, which sells alcohol, so to try and get people into the shops in the afternoon. So they're doing a lot of innovative things. They're partnering with, they've partnered with Nestle, who can license their products outside of Starbucks shops. So putting Nescafe, Nespresso, Starbucks together is quite a powerful brand when you think about coffee brands. In the US, they partnered with Alibaba to deliver coffee, believe it or not, very quickly. I mean, this has to be done quickly. It's got to arrive warm, right?
Sure.
So they're doing a hell of a lot. And when you think about their growth in China, they're opening a store, I think, every 18 hours. And where the Chinese consumer is right now, still relatively poor, despite China being a very big economy. The consumer is still poor, so the growth into the middle income class, if you can call it that, is expected to be very high. And the average consumer in China, as I'm sure you're aware, is a tea drinker. They don't really drink coffee, so they actually drink less than, on average, 1 cup of coffee a year. Henry's done that in
a couple of hours, I think.
But anyway, so in America, it's about 300 cups a year on average. So you've just got to get, that consumer to go from 1 to 2 cups. And they did it when you look at Japan, the Japanese consumer, also historically a tea drinker, now they're drinking more and more coffee. If the same happens in China, it will be hugely beneficial for Starbucks.
So huge numbers, and of course the rising themes as well, whether it be the partnership with Alibaba or the likes of Amazon. But what if we also link this to another international brand which is well known from a kiddie's point of view, but they do just so much more than just entertaining children with Mickey and Minnie Mouse, but their theme parks and of course additional revenue streams which are often underestimated. Disney.
Yeah, so I think this might just be my favorite stock on the market at the moment. This is a stock that's come under a lot of pressure over the last couple of years, and it's really because the market's seen Disney as undergoing or entering some kind of existential crisis. So what many people don't know is that the TV networks business actually accounts for around 50% of group profits.
Sure.
And a lot of that comes from ESPN, the sports network. And what's been happening is as people cut cords. In other words, they get rid of their expensive $60 a month cable subscription in favor of more affordable streaming on demand services like Netflix. That's put pressure on ESPN subscriber numbers. And they've dwindled from about a peak of 105 million to I think just under 90 million now. So people are starting to price this business like an old world ex-growth cable TV company. And what we've heard from management over the last 12 months is that they are busy reorganizing that entire business to go back to the market with a direct-to-consumer strategy. So they've launched ESPN Plus, which is almost the sports equivalent of Netflix. They launched it 5 months ago. They've already had 1 million subscribers sign up for the service. But the big one comes next year with Disney Plus, and that's going to be Disney's competitor to Netflix. And that's going to offer a huge component of exclusive content to that platform, along with all of their traditional franchises as well. And I think that this is a great opportunity to buy basically the world's best entertainment business at an old world valuation. And that's an opportunity that doesn't come along very often.
Very true. Clearly transitioning there from into a new school player with regard to the streaming services that they look to launch. So many interesting parts. And of course, this is where you come in as a viewer to share your thoughts and opinions and even send through your questions, which some of you just have. Well, one particular viewer, McDonald Malusi, has actually asked this question on Twitter. He asked, with South Africa's low economic growth prospects, is it time to buy stocks in the US or wait? And wait until when? Time in the market, right? Andrew, you want to tackle that one?
Wait until when? If someone's got that answer for me, please tell me.
I thought you had a crystal ball that you look into to come up with these decisions.
So unfortunately, I think it's more important to ensure that your portfolio is calibrated properly, if I can use that term, to ensure that you've got the right exposure. You know, South Africans typically are heavily overweight South Africa because you've got your house here, you live here, your income is generated here.
Pension fund is
your
here,
pension fund, you know, so typically most of your assets sit in rand. So I think, you know, getting that offshore exposure is critical, and I don't think it matters when. You know, you need to, I believe we live in a global society now, you need to be investing offshore as well as locally. But, you know, I think many people are very underweight offshore equities. From a valuation point of view, when's the timing right? You know, the South African market's cheaper than the US market. That we can categorically say. Well, I think we'll all agree on that. But does that mean that the South African market is going to outperform the US market, particularly in US dollar terms, because that's how you should be thinking?
Sure.
You know, then it brings in currency effects as well. It becomes very difficult. I don't think you should be watching, you know, or trying to time the market, looking, you know, when markets are, you know, coming back or going up. You should rather just be investing and staying invested for the long term. Forget about it and look at it maybe once a year, and you'll probably be very pleasantly surprised 10 years down the line.
Sure. So take the opportunity and stick it out for the long term. Another question follows up by saying that I have the following stocks in my US portfolio: Apple, Nvidia, Netflix, Amgen, Strike, Visa, Facebook, and Johnson & Johnson. I'm trying to avoid timing the market. Which ones currently offer the most value so I can increase this particular stock portion within my US portfolio? Henry, you keen on this one? Well, we touched on Facebook, and I guess we've highlighted the fundamentals about that particular stock, but given some of the others that he highlighted, Netflix, Apple, Nvidia, MJ?
So just going through the list, I think the one that concerns me a little bit on the valuation front is Nvidia. That's also a stock that's benefited greatly from the crypto mining trend. You know, their GPUs are used to mine cryptocurrencies, and I think the cryptocurrency market's undergoing a little bit of flux at the moment. So I think demand might drop off a little bit there. So that's perhaps one that I'd consider taking profits on, depending on when the investor bought the position.
Sure.
And the other recommendation I would think, and I'm going to talk my book here, I think you should switch out of Netflix into Disney.
Short and sweet. Well, hopefully we've managed to respond to many of your key questions, but if you do have ongoing feedback for us, stay in touch by tweeting us on social media at CNBC Africa and use the hashtag Portfolio Watch. You can also keep your emails coming to portfoliowatch@abn360.com. A big thank you though to both my guests this evening, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Henry Biddlecombe, Equities Analyst at Anchor Capital. Thank you for tuning in. We'll be back with more insight for you next week on Portfolio Watch.